Hello everyone, how's it going? In this video, we will talk about Lucid, trading under the ticker symbol LCID. Lucid has been one of the most speculated stocks in the Nasdaq over the recent years. Some said that it is the next Tesla, others believe that it's going to be a giant bubble, and everyone involved would like to see the company doing well to profit from it. As one of the heavyweights in the industry, Lucid is also one of the few companies that actually has a product. As time went on, the stock's price action and the investors' hype went through some huge roller coasters, and some are wondering if this is still a bandwagon they want to hop on. So in this video, we're going to look at Lucid and to see if the company still deserves to have a place in our portfolio. Lucid went public in the height of the EV craze back in 2020 by reverse merging with the SPAC CCIV. The market was very excited about the whole event as well as the industry because it could mark the beginning of a new era for so many stakeholders who want to purchase an EV stock in early stages. Back then, Tesla was making one historical high after another, and it seemed that no one can stop that bullish tendency. People were in a mindset believing that the bull market is never going to end because it hasn't really changed for almost 15 years at this point. The only true alternative for Tesla was NIO, but investors were also looking for some domestic alternative with better oversight, control, and I would say safety regarding the investment's value. So although Lucid was going public in 2020, it is a company with more than a decade of development as a private company, and it was able to prove to the industry that it is here to stay. We have to remember that the market mood was euphoric, and there seemed to be no obstacle that lies ahead of us. The current price action acts both as a major cooldown of the market and an opportunity for those who want to invest long term. Over the past few days, Lucid's share price dwindled below $10, and the sell-off doesn't seem to have slowed down for the time being. The price action went down by 12% over the past 5 days and down by almost 38% over the past 30 days. So overall, the market continues to be challenging with the growth stocks and EV stocks. The main catalysts seem to be like the potential interest hikes that the Federal Reserve is likely to apply. The next date to look at would be the Fed meeting at December 13th. So there is an expectation that the Fed will keep increasing the rate until the inflation is curbed. So far, it's not really having this kind of effect just yet. If we look at the long-term tendencies of Lucid price action, it's not difficult to see that the bubble gave us so much hope in the beginning, and so far it has bursted, or it bursted a long time ago. The market is no longer willing to blindly follow the latest hype that is behind us. I think that in some way the market doesn't want to persist on believing that there is a bull market, or to give us the perspectives or the perception, the impression that, growth matters more than profitability. On the other hand, it simply cannot afford to sustain this trend when, we know that there are issues regarding the supply chain, the flagship companies not doing so hot anymore, the high interest rates that we've said earlier, the uncertainties in the economy overall. So those things have been plaguing and weighing down the potentials of companies like Lucid. So the market has long predicted that there's going to be a bearish market after such a prolonged bull market, and that most stakeholders believe that it's going to be a rough patch for at least the next couple of years. The market has peaked twice in the past. The first time was caused by pure hype. The second time was triggered by the rollout of actual products. So Lucid remains a company that has investment value in the years to come. The main question in everyone's mind is, when should they enter in the stock? The long grind to lower price levels is likely caused by the market trends rather than the company's fundamentals. In that sense, things are not as alarming as they may seem. On the other hand, we should remember that sometimes, even if those grinds don't have an actual fundamental reason, they can last a very long time, and they bring the title to an unbelievably low price. Hyliion, PaySafe are some of the good examples showcasing this phenomenon. When we take a look at the company's financials, we can see the company's profitability. It is going up, but it remains to be improved, namely in the costs. Nevertheless, it's encouraging to see that the revenue has been increasing significantly from 97 million in Q2 of this year to 195 million in Q3 of 2022. On the other hand, the cost of goods sold increased as well, from 292 million in Q2 to almost 500 million in Q3. It's kind of interesting to note that the cost of goods sold increased more slowly than the revenue, showing that Lucid has been trying to control its expenses, but obviously there are improvements to be made. Another element to observe is the operating expense. I think that those correspond to the fixed costs, more or less, and over the quarters, they haven't fluctuated significantly regardless of the volumes. This is also potentially a good sign for the company because it stands to lose approximately $700 million in Q3 alone. And, that's going to definitely add up. So having at least some expenses that won't fluctuate, along with volume is a good sign for the time being. Now, as for the cash reserves, Lucid has an impressive amount, at least from the outside. But if we think about it, given that it has a deficit operation, it's between $4 to $6 billion on the balance sheet. And this would suggest that unless the operations pick up significantly in 2023, we're going to see additional rounds of dilutions coming up. Hopefully this is not gonna happen, especially when we know that they're gonna scale up the production in 2023. So if they manage to break even, then we're in a completely different paradigm. In terms of liabilities, the debt that Lucid took over the past few quarters gradually increased in size, from below the $2 billion to almost double this amount by the time we reach Q3 of 2022. Simply put, it is one of the three ways to keep things going. So they can either raise capital from equity sales, they can get the money from debt, they can also get the money by having operational cash flows. Now, in this case, they chose debt, probably because they think that it is still under control and it doesn't give additional ownership away. So for the moment, I think that the increase in debt level is normal. It is justified by the natural growth of the operations. It's something that we still have to keep an eye on for the future because this may involve going concern and cash flow issues later down the road if the level goes out of control. Some additional relevant aspects would concern the current ratio and the inventory turnover. The current ratio defines the liquidity of Lucid's assets and how well they can meet the short-term difficulties. This number is going, down over time, which suggests that they are getting less and less cash, or whatever that they have is getting less and less liquid. So they may have some punctual difficulties meeting the short-term obligations. The inventory turnover is a measure of how quickly they can sell the vehicles. The recent statistics would show that Lucid has no difficulty selling those cars, and that is a testament of Lucid's brand recognition. And also, it is a testament to the fact that Lucid has been positioning itself in the upscale segment, and in a certain sense, this has helped itself to weather this storm because maybe people with a lot of money to begin with, even though their investment portfolio may not look pretty, but it doesn't mean that they don't have what's needed to buy a car, right? So overall, those financial figures paint the picture of a company that's growing, but it lacks a little bit of discipline in terms of cost control. And they definitely need to scale up their operations in the year to come to improve their financial positions. Now, let's also talk about the shareholder composition of Lucid, because that's something very important to see if the company is for trading or investing. Right now, about 70% of the shares of Lucid are in institutional hands. This means that the price volatility will be lower than other growth stocks, mostly owned by the retail traders. The reason why that might be the case is because institutional shareholders are far more diversified in their portfolio holdings, and they don't mind the short-term volatilities. They also tend to stay in the stock for a longer period of time, which is also a good sign for those of us who want to stay in the company for the long run. Regarding the short selling pressure, Lucid has a sizable short position, around 5.2 million shares that are being shorted, which correspond to about 22% of the total volume. The volume of short positions can help us understanding like what some market participants think about a stock. And in this case, if they also want to see if there is a concerted, coordinated shorting operation especially from like the institutional side. In this case, I believe that the short sellers are anticipating the stock going lower. And I don't think that they are like institutions forming a war band. It's more like they just think that things are going to go rough for a while for some obvious reasons. And it's not necessarily something that they have discussed previously. So if the market trend turns, though, I think that much of those short positions are going to be redeemed. And that'll also like bolster the company's positions even further. So based on the analysis above, I would recommend to follow up closely to Lucid's price action over the next few days and to build up a position over the next 12 months in a closely monitored dollar cost average strategy. So in that sense, I would say that not every single purchase has to happen, every other day or every other week, especially now that we know that with the upcoming interest hikes, the price might be down for some time still. But regardless, like this is definitely a stock that I would recommend to keep a certain position in your portfolio for the long-term potentials. So I would recommend to commit a total exposure between 3 to 5% of your portfolio.